practiced last sum that defined
Yeah, and the
plan.
next question you gave the homework. I have done that.
That also you have done. Okay.
Yes.
Okay. So what I'll do, quickly I'll do this here, and you can
Okay.
cross check them.
Yeah. Okay.
So without explaining, I'm just doing this. This is the question, right?
Yeah. Yeah.
For this question,
Yes,
and
sir.
then you tell me anything if it is going wrong.
Okay.
So here first question is ending plan assets PBO. So that will come under PBO status itself, ending plan assets. Okay, fine. So I'll directly write here PBO and plan assets here. Opening PBO, past service cost 200, interest cost or interest expense, okay, is 150. Actuarial losses, because it is loss, I'll write in plus. Then benefits paid 300. So left hand side closing PBO is 2050. You got this number?
Yes, sir.
Okay. Then opening plan assets 2000. Actual return is minus 200. Then benefits paid is 300. Then contribution is 100. How much is this coming to? 2000.
1600.
1600. This is okay?
Yes.
Fine, okay. Then, so funded status. So closing funded status. $1,600 closing plan assets minus closing PBO. Okay. The next is TPPC. Is CSC plus PSC plus interest expenses or interest cost plus actual return. Okay. I can write actual return plus or minus, that is better. Then plus or minus actuarial changes. So CSC is 300, PSC is 200, interest expense is 150. Now actual return is in positive, right? So that's why I will write in negative, because actual return is positive 200, so I will write in negative. Actual return is positive or negative? 1 minute. No, actual return is negative. So I'm supposed to add this, sorry, because it is in negative, so I'll supposed to add it. Okay, then actuarial changes. Actuarial changes is in negative, so again I'm supposed to add it.
So in this, I have like subtracted actual return.
How much is it coming to total?
Yeah, just a second.
It's coming to 1050.
1050. Yeah.
Yeah, it's correct only, no? Because see, actual return is in negatives. That means it's a cost. So I'm adding it along with the cost. Actual return. Then actual changes is also negative.
Actual
So
return
both are.
minus
You understood why I'm adding? Because rest all are cost.
cost.
All these are
Yeah.
cost. And these two are in negative numbers. It's a loss. So that also I'm adding it with the cost.
Okay.
Then another formula is uh, benefits paid.
That means contribution, right?
Benefits paid or contribution. Yeah, you can say contributions made or contributions made. Minus closing funded status minus opening funded status. So benefits paid is how much? Benefits contribution is
100
100. So 100 minus closing funded status is minus 450
minus 450
minus
and
opening
opening is
funded
500.
positive 500. That is plus 1050, correct?
Yeah. Sir. Okay.
Hmm?
Understood.
The next is that accounting. Okay. So here the format is, I'll write the format first. CSC, PSC, interest cost, expected return. This we will consider till here for income statement. Next is actuarial losses or actuarial changes. Write changes, and then difference between. So CSC is how much? 300 will come income statement both the sides. Then PSC is 200, and for US GAAP it will go on the OCI side. Okay, then interest cost is opening
150.
opening PBO into discount rate.
Yeah.
So opening PBO is 1500
1500.
into 10%. So that comes to 150 and 150. Okay. Then expected return will be opening plan. So here it will differ. See, here the rule is opening plan assets
Into discount rate.
into discount rate. So opening plan assets
It's
is
2000.
2000 into discount rate is
10%.
10%.
It's 200.
That comes to 200. Okay. I'll write it here 200. Okay. So, and here it will be opening plan
Into
assets.
expected rate.
Yeah. Into expected return.
It is 12%. How about
So 2000 into 12%, that comes to
240?
240. Now, because all these are positive numbers, I will put it in minus. These are expected return. Okay. So if they would have asked income statement, only this much I need to do, and then I will
But
find
so
out the balance.
last time we didn't have like put in a minus, right? Maybe we have.
Last
Oh,
time,
this was my mistake.
just check.
Yeah, we have
Correct
put in
me.
minus last time,
Ah,
but I have done mistake here.
okay. Then actuarial changes. Changes is because of that 200, right? 200 minus 200.
Yeah.
So because it is 200 minus actual changes, see these two part will come OCI side.
Yeah.
So because it is minus, it's a cost. So I'm making it a positive number.
Yeah.
Okay. Then difference between is, it is the difference between actual return minus
Expected. So expected this minus 200 will take, and for actual minus 200.
1 minute. Actual minus expected, yeah. Expected. So actual return is how much? Expected return is 200. Right here. In this case, actual return is
Minus 200.
minus 200. No? Yeah. So minus 200 minus expected return is also 200.
Minus 200.
So that will become minus 400. So because it is minus 400,
No,
okay, I
sir.
should write here.
It will
minus
be like
200.
that, na? Minus 200 minus minus 200. So it will be minus 200 plus because expected return is also in minus.
No, expected return is in positive number. Expected return is in positive number. For accounting purpose, we were making it negative. See, actually, it is in positive number. Expected return will always be in positive. You will always expect positive returns. So, because it is positive number, so
Also done that
minus
one.
200
Minus
minus
200.
200, that
It's
will
minus
come to
400.
minus 400, and minus 400 means because it is a negative number. Okay. So, because it is a negative number, uh, so I am writing it positively.
Why?
Okay.
So this
Because it is a
negative.
cost, no? Negative number is a cost. So all negative numbers are I'm writing positively. See, this I wrote negatively because it is a positive number. Not understood?
Little bit confusion.
Okay. See. Okay, let me try here. See. Because this is a positive number, I'm writing it negatively. Is this clear?
Yes, sir.
So that means the actual number was positive number only. For my accounting, I'm writing negatively.
Okay.
The actual number was positive. Why positive? Logically, you just think because these are expected return. This is interest cost. Both are opposite.
Okay.
Interest cost means what? Cash is going out then for me.
Yeah,
Expected return is
expected.
cash is coming in. So they both, I cannot add. Na?
Okay.
Is it okay?
Yes, sir.
Now, when I'm taking the difference, actual return, actual return would be negative. Expected return, actual return can be positive or negative. But what you are expecting from your assets will always be positive. No?
Positive.
So, actual return is minus 200 only. Minus then 200 actual return, which comes to minus 400. Now, because it is minus 400, that means it is my cost. And all my cost, I'm writing it positively here, right? This is my cost, 300. This is my cost, 200. This is my cost, 150. So, I will write my cost also as 400 here. Is it okay?
Yes, sir.
Now you see, try this one. Actual return is what? 200. So, actual return is minus 200. Minus, what is the expected return here? Expected return is 240,
240.
positive 240. So I will write here minus 240. So that comes to
By
minus
440.
440.
So we'll
Now,
write
because it is
positive.
minus, I will again write it positively,
Yeah.
440. Okay, so net what I have done, see, if net if you see, expected is, see this one. Net, these numbers are little like everywhere 200 is confusing. Okay, so see, this is what I expected, minus 200, and the remaining amount I'm writing over here. Then. Is it
Okay, sir.
okay?
Yes, sir.
Now you add up all these income statements. 300 plus 200 plus 150 minus 200. If they ask only income statement, you have to add only this much. Okay. Now we will calculate the entire balance. Yeah,
It's
left hand.
450. Income statement is 450.
Huh. And here.
It's minus 200.
Hmm.
No, sir, wait.
Mm-hmm.
The 400 is in positive, right?
Yeah.
So we will write 600.
Yeah. Okay. So this total comes to 1050, which is TPPC. Similarly, now You calculate here.
So it's 210.
Hmm.
840.
Okay.
Just the minus and plus mistake I have done.
Yeah. That's where you need to be a little more careful in that minus plus. Okay.
Okay, sir.
Okay. Okay, fine. So this is okay. So now we will do one more sum for better practice.
Okay,
That
sir.
is book sum. Yeah, just go through this question now.
Sir. Okay, sir. Pension cost. So this pension cost, what is this?
Which one pension cost?
Yeah, this pension cost reported under US GAAP, pension cost reported under IFRS. That calculation part that we have to calculate.
That is the balance. US gap balance. And under IFRS, what is the balance? This
Okay,
one.
that table is called pension.
Yeah.
Okay.
Under IFRS, this is under IFRS.
Okay.
Okay.
Okay, sir.
This is under US gap. Okay. So we'll try this one now. See, if you notice, employer contribution, CSC, this is all fine. We are familiar with all these terms now. End of the year obligation is also given. Increase in benefit obligation due to changes in actuarial assumption. It is also okay. This is also okay. This one is little unfamiliar. We are unfamiliar with this, right?
Yeah.
We didn't see this transaction.
Yes.
Unamortized actuarial losses, US gap only.
Yeah.
Okay, so we will keep that aside for the moment. Expected return, okay. What is this? Yield on long-term investment grade bonds? That is nothing but discount rate only. Okay, so theoretically they may ask also, how is discount rate calculated? The discount rate is nothing but the yield on long-term investment grade bonds.
Okay.
So we'll do as usual. First we'll form the format. Okay. So the format is PBO. What you do is you also do on your own. Okay. You have the questions in front of you.
Just I'm finding in the books. There it is. So after which reading this question is the
See, come to model quiz 8.2. Above
on
that
that?
one.
Yeah, sir. Okay, found it.
So based on the question, you write now on your own. In case if you find difficulty, then you look at the board. Okay. So you try on your own now.
So they have given us the beginning of the year benefit obligation, end of the year benefit obligation. So why we are
Yes.
calculating this?
Some other missing number will be there.
Okay,
Okay.
it's like that.
Employer contribution 1200. Current service cost 1850. End of the year obligation 43,619. Increase in benefit obligation due to changes in actual. 29. Beginning of year plan assets. End of the year. Actual return on plan assets 1795. Benefits paid 635. Expected return 6%. So PSC is not given, right? Past service cost
Yes, sir, past service cost.
is not given. Okay, fine. Interest cost is also not given. Now,
So we can find now. No?
yes, yeah. So this will be 38,870
Right,
into
to 7.5%.
7.5 percentage.
2915.25.
291.
5.25.
Okay. Now just see if all these are matching.
Yes, sir.
Yeah. Let's see here. 38. This is PBO 38870. This is right. This is right. Interest cost is 2915, right? 619, 619 and 635. Just check this number is matching because we have taken in minus. They have
Which one?
taken actuarial one
So I
positive
also
number.
taken in minus. Achha.
These two are in minus, no? Actuarial
Yeah, I have
changes.
taken in the minus only. But they have taken plus actually. Mm, actually, increase in benefit application due to change in actual assumption.
Actuarial losses or gains 619. 619
This one
increase in
increase.
benefit obligation due to changes in actuarial assumptions. Okay, okay. So now the obligation is going up. That means a loss 619. So it will be positive number.
Okay. I've also taken this in
Yeah,
minus.
right. Now you see if it is matching to 43619.
Yeah. 38870. Yes, sir, matching.
Right hand side you check.
Yes, sir, matching. So, sir, past service cost is nothing.
No, nothing. Yeah, possible. Yeah. Okay, so the question is beginning and ending funded status. So that anyways there was no need to calculate for that all this. This is the difference is beginning funded status. This difference is ending funded status.
Yeah.
Okay, but we'll still calculate because later when we do TPPC, it will be useful. So beginning funded status is 28322
No, sir, 3. Achha.
minus
Hmm.
28322 minus
Yeah.
38870. How much?
It's 10,548.
Yeah.
Minus.
Then
3066. It's 12,937.
okay, fine. This is done. Then we will do that TPPC now. So TPPC formula is CSC plus PSC plus interest cost. Okay. Then plus or minus actuarial changes. Plus or minus actual return. So CSC is, so what is CSC?
1850.
Okay, 1850. PSC 0. Interest cost we found out, right?
2915. 2915.
Then actuarial changes, again that is
619.
cost. So that will increase. It's a cost because changes, it is increasing the problem, right? The obligation is going up. Actual return, actual return,
1795.
positive or negative? This is positive number, so I will
Negative.
minus that. 1795. Calculate.
3589.
Now there is one more way to cross check. Benefits paid. So, or employer's contribution. Not benefits paid, employer's contribution. Did I write? How did I write here before?
What, sir?
This is employer's contribution only, not benefits paid. This employer's contribution. This is wrong. Yeah. Employer's contribution or contribution made. Okay. So, employer's contribution minus ending funded status minus beginning funded status. Employer's contribution 1200. Ending funded status is 12937. Then opening funded status is minus 10540.
Sir, 12937 is also in minus, right?
Oh, this is also minus. Okay. So it will be minus 2000 something, right?
Yeah, 2397.
So it will become plus now. 2397 plus 1200.
3597.
It's not matching, no?
Something. No, sir. Upper you have written wrong. It's 3589.
Oh, this calculation.
Yeah.
But still then it is not matching.
Hmm.
Just calculate again. Let's see in the book what is the answer given.
They haven't calculated this.
Acha, they have not calculated. Okay. Okay. Okay.
So it's 3589 only.
Here. Here.
Just 12937 minus. Then add in 10540, 23397, 2397, and then add in 1200. One second, it's 3597 only.
Okay, why that gap is coming? I think again we have to calculate everything then. This is opening. Okay, let's see the
So
funded
only
status.
8 rupees gap is coming, so it will be also wrong.
Wait. 10548. 10554. Here is the gap. 8 rupees gap. So we can check this one. Beginning funded minus. Okay, so I think there is.
So I have written only this only 10548.
Acha. So just calculate this 1 second. So I only wrote wrong. 8.
Minus 3. Yeah, so it's 8. I've also written 8 at the last.
So beginning funded status. This is 8. So you calculate this number is wrong then. Again you calculate. Minus
It's 2389.
Now 1200 plus 2389.
3589.
Yeah, okay. Then next is income statement. This is income statement, OCI. This is income statement, OCI. Okay, then yeah, so I'll write the format. So this much is income statement. After this, actuarial changes. Hello, can you hear?
Yes, sir.
Yeah. Then here it is difference between actual and expected return. Okay. So first of all, what is CSC? How much?
So, this 1850.
So 1850 in income statement. PSC is 0.
Interest is 2915.
2915. Expected return here, opening assets.
To discount.
No, here opening assets into discount rate,
Opening assets.
and here opening
Assets.
assets. You will get return on assets only, no?
Right. So
Into expected return.
expected is 7.5.
Ah,
That is discount.
this is discount rate.
2124.
This one 2124.
Yeah.
Now this is a positive number, right? So I will write it negatively.
Yeah. Okay. And then
Here
that
also
one
negatively.
is an expected return, right?
Yeah.
With 6%.
Hmm.
Will be 1699. We can round it off to 17, right? 1700.
16.
99.
Okay, but it will be in minus. Okay.
Okay.
Then actuarial
So it's
changes.
1699.
Okay. Now actuarial changes is 619, and it has gone up, so it's a loss. 619, so it's a loss, so I'll write it positively here. 619. 619. Okay, then actual return is 1795. So here 1795 minus this part 2124. How much is that?
2124 minus. What do you have minus? Actual
Two
value.
one 1795. Yeah,
329.
329. So actual return is lower. So that means expected return is higher. So net it is in minus, and so because it is in minus, it will come positively. Is it okay? Because my
Yes.
actual return is lower, that is the logic. So
Okay.
because the actual return is lower, that means I'm incurring loss, you think. So it is in positive number. And here 1795 minus expected return is 1699.
Yeah. 1699. It's 96.
And here it is positive number, so I will write here as
Negative.
negatively. Okay, now you calculate all this. Hmm.
So for income statement, it is 2641.
Hmm.
Both are in positive, right?
Hmm.
948.
Hmm. Add up.
3589.
Which was our TPPC, right?
Yeah.
Hmm. Here also.
Six zero. And 850 plus.
Just,
Acha, that is
just
a minus.
1 minute. Huh? Hold on, wait. How much
So,
is this coming?
yeah, it's 3066.
Ah,
And that is 523. Sum is 3589.
yeah. Okay, so it is correct. 3589. Now, if you remember, we ignored this transaction. We'll
Yes,
just
sir.
focus on that now. Okay, but the rest is all you just cross check, all are fine. 1699 we got, right? This is also okay.
6264. Yeah,
Expected
right.
return, discount, interest. Okay, you can just have a look at the answer
Yes, sir.
once. Now you see how they can ask questions. See, here they said pension cost in profit and loss. So only profit and loss balance they want.
Yeah.
So profit and loss is balance according to US GAAP. So the answer is
3066 in US GAAP.
3066. Yeah. So this way they will ask. Okay. Then pension cost in profit and loss as per IFRS. That is this
2641.
balance 2641. Okay. Profit and loss. That means income statement. Okay. Now that one left out transaction. Okay. 3150. No? We didn't do anything for this transaction. Rest all we are fine. Correct?
Yes, sir.
Now just read this part.
Okay. Okay, sir. Understood. Correct. Accordingly required under right.
Okay, see, for any period, once the beginning balance of actuarial gains and losses exceeds 10 percentage of the greater of the PBO or plan assets. So first let's focus on greater of the PBO or plan. So in our sum, what is greater? Uh, Opening PBO is 38,870 and opening plan assets is 28.
2832. Yeah.
3. So bigger one is this one. So let's focus on this one. So 38870. So
10%
here,
of this.
if if opening balance of actuarial gains, so I'll write that point. Opening balance of PBO opening PBO. Okay. Opening PBO and opening plan assets. Sorry. Opening balance of actuarial gains or losses. Opening balance of actuarial gains or losses exceeding 10 percentage. Okay. So opening PBO is 38,870 and opening plan assets 28,322. So this is greater. So I will focus on this one. So 10 percentage of the greater one,
3887.
of the greater one, that is 10 percentage of 38,870, 3887. Now opening balance of actuarial gains. This is the one. Actual opening means this one, unamortized actuarial losses 3150. So this 3150, if it is greater,
Okay.
okay, if it is greater, in this case it is not greater.
Yeah.
When it is not greater, whatever we have done, everything is fine.
Okay.
Okay, in this case it is not greater, so everything is fine. But suppose if it is greater, then what should you do? Okay.
Okay.
Okay, so in our sum we don't have to make any changes. Is this fine?
Yes, sir.
Okay. Now you see, if it is greater, an excess amount. So what is that excess amount? So instead of 3150, assume it is 4,000. Then what is the excess amount? Calculate.
113.
113. Okay, this is the excess amount. This is just an assumption, 4,000 we are taking.
Yeah.
Okay. An excess amount outside the corridor. Outside the corridor means outside this, outside the corridor means outside this 10 percentage. That is 113.
Okay.
Is amortized as a component of pension cost in profit and loss over the remaining service life. Let's say his service is next 10 years more. So every year I'm going to amortize 11.3 in profit and loss.
Can you repeat this?
Yeah. So this is the excess amount, right? This excess amount will
Yeah.
be amortized every year till the remaining service life
Okay.
of the employee. Let's say he's going to work for 10 more years. So for 10 years, this extra amount will be shown in the income statement, profit and loss. It is amortized.
Okay, sir. So this will be in the PNL, so
Yes,
that
yes.
income statement of US GAAP,
Every
extra
year,
thing.
yeah, every year 11.3 they will show. Okay. In our case, in our case, we don't have any such thing. Here it is given. No amortization is necessary. Okay.
Sir, at what rate we will amortize?
Based on the remaining service life of the employee. Now, I'm assuming he's going to work for 10 more years. So divided by 10. If they say 5 more years, 20 more years, divided by 5 or 20.
Okay, sir. Done.
Okay, so the sum is fine now. Okay. Now, you can even go through this also. Current service cost is shown under income statement. IFRS is also income statement. Past service cost will be shown under OCI and IFRS income statement. Then can you understand this line now? Amortized over service life in subsequent
Yes,
years.
sir. Yes, sir.
This is that extra corridor approach.
So we will add that in past service cost.
Uh, it will go in past service cost. Yeah. Yeah. Okay. Then,
It means in OCI.
yeah, that will go under OCI only. Na? See
But
here,
if you income statement,
OCI amount, past service cost.
I have written an income statement, that income statement.
Where OCI only, na?
Okay, sir.
Okay. Then see this one, interest income statement, expected return both income statement. Actuarial gains and losses will come under OCI,
Okay.
not amortized both. Okay, so this is fine, right? So
Yes.
this much is fine in this topic, but
Yeah.
if you want to read theories, how your strategy should be is, see, theory begins from here. Whatever you
Yeah.
can understand, you understand. There are certain things which are like highly, they have just complicated stuff. That if you
Okay.
want to, leave, you can leave. Doesn't matter. Okay, because most likely questions will come from whatever we have discussed so far. Okay. See, for
Okay.
example, here, uh, one you can read. I'll tell you what you can probably read. Okay. So here, this part you can read. These all are okay. Only this page, entire page, you may read.
Okay.
I'll tell you where it will be very complex. Okay. This one. This also you should read. And this as well. This kind of questions they prefer asking under IFRS, under US GAAP. Okay, here. This one is very complicated one. This one part. Okay, if you can understand, read. Otherwise, you leave it. Doesn't matter because it is just this part only. What we have done, they have explained, but it is not a very friendly way. See this. Uh, okay. See this one and this one. Okay, these two
Okay.
uh, only explained there, but not very friendly way. So if it is confusing you, you better leave it. It is fine. Okay,
Okay.
but you can try. It doesn't matter. Whatever you don't understand, don't break your head over there and say like you are going to understand at all cost. Doesn't matter. Okay, even if you understand 80% from this entire subject, that 80% you should be 100% sure. Okay, that should be the strategy rather than saying I will understand 100% all 100%. That may not happen then. Okay, 80% if you understand, remaining 20%, even if you play with your luck, it will help you some extent, and even if it doesn't help, 80% is good enough to convincingly pass. Okay, so whatever you should know very clearly. That is more important. Okay. Then, yeah, even this part you can read, but again, whatever you can understand. Rest all, as I said, uh, it's all fine if you don't get it anything. But whatever we have done, na practice point of view, practically practice that very well. So one paragraph, two paragraph here and there, if you don't understand, it's not at all your worry. Okay, this table also it should be easy. If if you practice this very well, this table you don't probably have to remember also.
Yeah.
Okay, then um, this one. actual, this kind of theory they may ask. Actual cash flow is reported in operating activities. Okay. Then remember in level 1 we had disclosures. I told you to skip
Yeah.
here also disclosures. If you want to remember, remember. Otherwise you skip it. There are only 3 points here. Okay. Then here also this line you can remember. Okay, this line. So this is enough. Okay, so you read this couple of times and then you also try all these questions.
Okay, sir.
Fine, we'll stop now here. Okay.
Yes, sir.
Okay.